Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Let's look at the response to the final question of the CSEC Principles of Accounts 2021 paper. And we begin with part A. State two benefits of a partnership. What you're asked for are two advantages of a partnership business. Example, more capital can be raised, pooling of skills and expertise, sharing of managerial responsibility, and there are others. Moving into part B, Avril and Bernice formed a partnership with the following agreed terms. Interest is to be charged on drawings at the rate of 10% per annum. Partners are entitled to receive interest on capital at 12% per annum. Bernice is to receive a salary of $78,000 per annum for holding a managerial position in the partnership. The remaining profits and losses are to be shared in the ratio of 3:2. At 31st of May 2021, the following information was extracted from the books of the partnership. And we have the capital balances, we have the current account balances, and the drawings value per partner. Net income for the year ended 31st of May 2021 was $152,000. What you're required to do is to use the information above for Avril and Bernice to prepare the appropriation account for the year ended 31st of May 2021. Now we're going to look at the appropriation account. The first thing that you begin with is the net income, which was provided in the question of $152,000. To that, you're going to add the interest on drawings per partner. So from the information provided, the partners' drawings, we're seeing where Avril is $17,000. The rate for the interest on drawings, don't forget that it is 10% per annum. So therefore, Avril's drawings is 17,000 times the rate of 10% to give us the interest on drawings. And that would give us a value of $1,700. For Bernice, let's look at Bernice drawings. We're seeing where Bernice drawings is $46,000, and that is multiplied by the rate of 10% to give us the interest on drawings for Bernice, and therefore that is a value of $4,600. Now that we have the interest on drawings for each partner, we can total interest on drawings, which is $6,300. This $6,300 is then added to the income of 152,000, which give us a total of $158,300. Our next step is to less the interest on capital, and we have the interest on capital per partner. For each partner there, the interest on capital, don't forget that the formula is capital multiplied by the rate. So for Avril, we're seeing where the capital is 60,000. The rate for the interest on capital there is 12%. So the 60,000 multiplied by the 12% there give us a value of $7,200. Now we move into the calculation for Bernice, and Bernice capital is 110,000. We're going to multiply that by the rate of 12% to get Bernice interest on capital, and that is a value of $13,200. Now, having calculated the interest on capital for both partners, we can put in the total, which is 20,400. That is the 7,200 plus the 13,200, which give us 20,400. Our next step is to pick up the salary. And we're seeing where Bernice is to receive salary of 78,000 per annum. So that information is entered. Once you enter that, you can now add up all that you need to subtract. So that is the interest on capital total of 20,000 plus the salary of 78,000, which give us a total of 98,400. That 98,400 is then subtracted from the 158,000, which give us a profit that is remaining of $59,900. That $59,900 is then shared between the two partners using the profit and loss sharing ratio. The profit and loss sharing ratio from the information that we have provided is 3:2. So the profits and losses are to be shared in the ratio 3:2. We have a profit, that is what we will be sharing between the two partners. The profit is 59,900. For Avril, it is 3/5 of the 59,900, which give us a value of 35,940. And for Bernice, which is 2/5 of the 59,900, and that gives us a value of $23,960. Those two figures added will give you a value of 59,900. And don't forget that once you share accurately, you should get back the very same figure that you got for the profit or the loss. In this case, it is a profit. We are now going to move into the second part of B, which asks us to state what the opening balance on Avril's current account indicates. And Avril's current account balance is 15,000, and beside that you're seeing debit. This means that Avril's current account balance is a debit balance. What does this mean? It means that Avril has withdrawn more than her worth in the business and is therefore owing the partnership that $15,000. So basically, because the balance is a debit balance, it means that the partner is owing the business. Why? Because the partner has withdrawn more than what she has into that business. We're going to move into part C of the question. Avril and Bernice decided to keep the business's petty cash book on an IMPER system. Part I, state two reasons for the creation of a petty cash fund. You could use any of these or any other suitable response. The main cashier is saved from routine work. The task of handling and recording small payments can be given to a junior member of staff, or you could use it saved time in posting all these small payments one by one to the ledgers. So those are some reasons for using a petty cash fund. We're going to move into part 2 of this question. So we're presented with some information as it relates to petty cash. And from that, you are asked to write up Avril and Bernice petty cash book for the month of June using the form provided. Balance and rule the petty cash book at the end of the month, and to restore the petty cash fund at the end of the month. So here we go. Using the information provided, the first thing that we're going to enter is the float, because of course the petty cashier would need some funds to work with. And that is the cash provided there. And the date is June 1st. And because it is a receipt, we're going to enter that in the received column, and that is 200. The received column, don't forget, that represent the increase in the value of the petty cash. We have 4 expenditures for the period. Now we're going to record those in the petty cash book. Remember, when you're recording your expenditures, the value will be entered twice. once under the total column and once under the specific analysis column. So here we go with the first expenditure, which is June 3rd. The details there is traveling. The value is $50, and that is analyzed under the traveling column. Next, we move into June 9th. The details is stationery. The value for the stationery is 35. Look for the specific analysis column, and again, that 35 is entered. Next expenditure is June 20th. Details, cleaning. The value for cleaning there is $20, and that is recorded under the cleaning analysis column. And the final one is June 29th. Details is refreshments. The value for refreshments is 40, and that is analyzed under the refreshment column. We're now going to total the respective columns, beginning with the total column down to the refreshments. The total column is 145, traveling is 50, stationery that's 35, 20 for cleaning, and 40 for the refreshments. We are going to single line above and double line the analysis columns. We're just going to put single line above for the total column because we need to continue with that column. Now, the analysis columns, if you should put in your folder, that would be general ledger, because these expenses would be, their account would be in the general ledger. Now that we have that, we're going to proceed to restoring the impress, because that is to be done at the end of the month. Because it is to be done at the end of the month, you're going to restore before you balance off. Restoring meaning you want to get back the float to what you had started out with. And if you had spent 145, it means that what you have left in hand is $55. What we would need to get back this float at what we started out with is to reimburse the petty cashier with what was spent, or the amount that needs to be added to that 55 to take it back up to $200. You could minus that 55 from the 200, you would get the 145 that was spent. And the reason I went into that explanation and not just say give back the petty cashier what was spent, there could be a case where the petty cashier might have received some small payment, and that would have decreased the value of what would have been needed to restore the float. So in this case, 145 was spent, there was a balance of $55. What we need to get it back to the agreed float is to give back the petty cashier at the end of the month, June 30th, some cash, and the cash value that we need to give back to the petty cashier is $145. Now, we're going to proceed to balance off the petty cash book now that we have restored the impress, and the value that we need to balance off the petty cash book on the debit side, which is the receive column. We're going to compare the receive column with the total column. That is, the receive column is the debit, the total column is the credit. So the receive column is $345. For the total column, which is the credit side, we are seeing 145. 145 from 345 give us a value of $200. So therefore, our balance carried down is $200. We are now going to put in our totals. We have 345 for the receipts. This 200 plus this 145 give us 345 as well. Don't forget to put your single line above, your double line below. for your totals. And then the final thing that is left for us is to enter the balance brought down, and that is July 1st. The details is balance brought down. This balance carried down is then placed on the debit to become our balance brought down, and that is 200. Having balance off, when you start the next month, the value that you start with should be equal to the float that the cashier had started out the month with. Okay? And that is $200. So it should not be nothing less, nothing more. Once you restore accurately, once you balance off accurately, then the value that the petty cashier would start with would be equal to what they had started out the previous month with. And that basically takes us to the end of question 5, which is the end of working the Principles of Accounts 2021 paper.
Like, share, and don't forget to subscribe.